So Americans don't seem to like gold. I'm not sure Canadians feel much differently or others around the world, but central banks sure do, and I think that tells you something. Now China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, U.S. was down 1,000 tons after losing, 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think. Today, the inflation is coming from the supply side. Some of the things we talked about, higher fuel costs. I mean, everything has to be transported, so fuel is part of everything. It gets built into the price of everything. And there are other shortages and bottlenecks and costs that have to be taken up by manufacturers and distributors. The Fed can't drill for oil. The Fed can't plant wheat. The Fed can't make semiconductors. So they can't do anything about this. And the supply chains are breaking down. They were breaking down before the war in Ukraine, but Ukraine has made it worse. The Fed can't do anything about cost push. They can't do anything about the price of oil. But they're looking at the demand side, saying, hey, if this supply thing goes on long enough, eventually the psychology will change and we'll get demand pull and behavioral. And that is really hard to change. So what they're trying to do, they know they can't change the supply side, but they're trying to squash the demand side before it gets out of control. Supply side inflation can feed to the demand side. Demand side inflation can feed on itself. But supply side inflation alone does not feed on itself. It tends to destroy itself. There's an old saying, the cure for high oil prices is high oil prices. In other words, if you make them high enough, and going back to what I just said about putting gas in your tank, think of all the things you're not spending money on. And that causes business failures, layoffs, higher unemployment, lower velocity of money. You stay home, like you said, you don't go out basically. And that's what's happening now. So we're starting to see inflation come down. When it comes down a little bit from 8.2% to 7.7%, people go, "Oh, it's still high." Well, it is still high, but that's a noticeable drop, and we've seen that a couple of months in a row. What's going to happen faster than markets and investors expect is that this inflation is going to come down so fast. It's going to be a strong form of disinflation. Now, disinflation is still inflation, but it's lower inflation. And in terms of response functions, it bears a closer resemblance to deflation than it does to inflation, even though it's still a form of inflation. When inflation is coming down, what else is going on? Well, real interest rates are going up and the economy is slowing down. And then it could even tip into deflation. That would be a shock to the system. In that world, cash is your best performing asset because the real value of cash actually goes up in deflation when everything else is crashing around you. So yeah, we're in inflation right now. It's painful, but it's starting to fade more quickly than people expect. And my forecast, based on a lot of analysis, and it's all in the book, Sold Out, is that this disinflation, borderline deflation will prevail, and by really just in a few months, January, February, March 2023, if not sooner, we're going to be in a very severe recession, and people are going to be surprised at how quickly inflation comes down, and they won't be positioned for it in terms of their portfolios. I mean, for example, a 10-year Treasury note would be a very good performing asset in this world because yield to maturity on 10-year Treasury notes. It's been recently 4%, but now it's around 3.5%. That could come down to 2.5% in a heartbeat, even lower, and that would produce huge capital gains. So it's a big deal for investors and asset allocation and portfolio management. And a lot of people don't see the disinflation coming. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. They're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, OPEC Plus, China individually, all these countries are the Eurasian European Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. When the price goes up, I would say that what's really happening is the dollar is going down. In other words, I think of gold by weight. I'm interested, do you have a ton? Do you have 50 kilos? Do you have 5 ounces? Whatever you have as an individual investor, as a bank, I think of it by weight. Because when someone says gold's really going up, I said, well, no, the dollar's going down. You need more dollars to purchase a fixed quantity of gold, which means the dollar's worth less. And when people say gold's really going down, I say, no, the dollar's worth more, and you need fewer dollars to purchase a quantity of gold. In other words, when people talk about price, the first thing they do is they're really talking about dollars. There's a euro price for gold, but the world market is based on dollars. You're privileging the dollar as the numeraire. The numeraire is your counting system. Is it yards, inches, feet, whatever? And if you put the dollar first and say gold is in dollars and it's going up or down, I think you have it backwards. I think you need to put gold first by weight, and then if it's worth more, the dollar's going down. If it's worth less, the dollar's going up. In 1914, when World War I started, all the major powers went off the gold standard. They said, we got to keep our gold. This is real money, and this is how we're going to win the war. And the Bank of England was faced, and the Exchequer was faced with the same choice. Keynes was an advisor to the Exchequer. He said, don't go off the gold standard, stay on the gold standard. And the reason was that if you did that, you would preserve your reputation and preserve your credit. He said, the war is not going to be won with money or gold. It's going to be won with credit. But if you stay on the gold standard, you'll have the credit. And that's exactly what happened. Jack Morgan, Pierpont's son, organized huge loans for England and France and nothing for Germany. And England won the war. So the point is, Keynes got that right. Now, flash forward, 1925, he's talking to Churchill, and Churchill wants to go back to the gold standard. And Keynes is telling you got the price wrong. We can't go back at, £4.25 or whatever the exact rate was. We've got to devalue the sterling by half because we doubled the money supply to fight the war. Churchill ignored Keynes's advice, and they went into a recession, depression before the rest of the world. Flash forward 1944, you're at Bretton Woods. Keynes wanted a gold standard. And this isn't speculation. He wrote papers. He gave formal presentations. So 1914 is pro-gold. 1925, he's telling Churchill, you're nuts. You can't go back to a gold standard at this price. 1944, he's pro-gold again. I call that a pragmatist.